Welcome, everyone. This is the very first episode of the NPWC Wealth Podcast. And we have a very special guest joining us today, Jason Jogia. He is from Avenue Living. And Avenue Living is a very important partner to us because they manage two of the core investment holdings that we use in our client portfolios, the Avenue Living Apartment REIT Core Trust, and then the Avenue Living Mini Mall Storage REIT. We're going to focus on the Avenue Living apartment REIT for today. And we'd just like to welcome Jason to the call.
Thank you, Cody, for having me.
Yeah, so Jason, you're the Chief Investment Officer there for Avenue Living. And can you tell us a little bit about what that role is like there and how that relates to the apartment REIT?
Yeah, so in my capacity as Chief Investment Officer, I oversee the entire organization's financial operations. And really what I mean by that is, we're the custodians of over $4.5 billion in assets under management. We've got, four different investment vehicles, all that allocate capital and then have operating vertically integrated operations servicing that allocation. And really it's ensuring that we are investing in the right assets that are on strategy, ensuring that the assets perform appropriately, and then ensuring that our operations is prioritizing the asset plans and the investment strategies to then deliver the appropriate risk-adjusted return to the investors. My background, before I was at Avenue Living, was in banking, and I ran the debt book for one of the larger banks in Canada in the Prairie region. It's actually how I got to know Avenue. And then academically, I'm a bit of a finance geek. I've done 3 degrees in finance, and cap structuring has been my specialty or my expertise. And then currently pursuing my doctorate in the same subject. So it's something that kind of gets me up every day is the fact that I can be a great practitioner here, but also the scholarly work that I do to do research-based methodologies to optimize this business.
Nice. That's incredible. And just for our listeners today that maybe are invested in the apartment REIT or aren't invested in the apartment REIT but are interested in an allocation, can you just tell us a little bit about the apartment REIT, how it came to be, and the performance and the specialty area of it?
Sure, absolutely. So, the apartment REIT story is an amazing one. Today, what is now north of 14,000 units across 22 markets in Canada and the US, was born very humbly 16 years ago. And, a few co-founders came together, primarily Anthony Giuffre, who's still in the business to this very day, with an idea of buying multifamily for reoccurring cash flow, and started to look for a great asset. And through the search of an asset, what they quickly recognized was that there was a niche within the market that was fraught with fragmented ownership. And that niche was workforce housing. It was buying the lower medium density assets, bringing in a capital investment to those assets, and optimizing the operations through the vertically integrated property management system to extract reoccurring cash flow and value. And over 2006 to today, that business has become the flagship offering of our group of companies with over $3 billion in assets under management and 14,000 units. And the synergy with workforce housing really is that you can start to become market agnostic so long as that you're being customer specific. And what I mean by that is workforce housing, it's an asset type, but it's also a customer profile. And it's a customer profile of those that are making, anywhere between $15 and $50 an hour, who are renters by necessity, and who really are overqualified for affordable housing, but underqualified for home ownership. And that tenant base exists in every market across the world. I mean, across North America, across Canada. And pile onto that, when the guys were building the business, they weren't really able to go compete in a Toronto or a Vancouver, and even at that time in a Calgary. So they started with this outside-in strategy, finding geographies that arguably were impervious to economic cycles. And easy to say that before you go into those markets, but after the great financial crisis and the commodity meltdown and the COVID pandemic, and then the year that we just went through with all the stock market volatility and interest rate and inflationary periods, they continued to be impervious. And why it was that focusing on the US and the Canadian Prairie region, focusing on what we would call trading hubs, secondary, tertiary markets, and primary markets within that region, we ended up with a very defensible position. No one market had major correlations to a single economic base. And the customer that we focused on were very gainfully employed in those markets because there's a Walmart in most of our cities. There's a Home Depot in most of our cities. They were the employees that are working there that need a place to live and need predictability in the experience that we give them when we service them. And that's what's created this defensible strategy that's proven the test of time. And when we look at the returns that have been associated with it, it really is akin to the fact that while the market had one of its worst years on record in the last decile, we were able to really outperform because the customers were tenacious, defensible, and we were able to flow through the increased cost of business, enhance margin, be synergistic, and do all the things that we needed to do to deliver returns that were near 12% across our portfolio, which were very, very strong risk-adjusted returns.
Absolutely. And that's one of the actually problems that we come across is because you've had such strong returns, both in the apartment REIT and the storage REIT, clients come to us and just want to put more and more money into this particular part of the portfolio. And we have to talk about diversification. And so the positive performance has been very, very, very great for us. And with that, what would you say are, some of the differences? Because private investments are becoming a little bit more popular in the retail space. And some people don't fully understand the difference between a private REIT and a public REIT, and why a company like yourself would operate a private REIT as opposed to a public REIT.
Yeah. So I would say that, one of the main differences between the two come down to correlation to the broader market. When we think about investing in real estate, there's really three ways to do it. Number one, you own an asset. A lot of your clients might own assets. They might own apartment buildings or little commercial strips. It's a great way to park money in real estate, but you have to live with the, pardon my language, the pain in the ass aspect of operating that asset. And the challenge is that diversification can become very difficult because capital is finite for everybody. And by being able to diversify both by asset class and or by geography could become difficult in the direct ownership method. That then leaves you through indirect ownership, which is, the concept of the REIT. The REIT was born 50, 60 years ago to allow investors to allocate money to real estate in a tax efficient basis to get access. Since the inception of the REIT, there have been two ways to invest in them. One was public, one was private. And the idea was that public would allow the investor to have immediate liquidity whenever they wanted. And private was one that had liquidity, but it would be subject to terms, subject to redemption, subject to whatever that term was for that particular fund. And what was really interesting is that the private REIT space tended to attract a lot more institutional capital than the public REIT space. You would see institutions going after private REITs because the correlations of public REITs to the broader indexes is very strong, 0.4, 0.5, 0.7 times correlations, or 70% correlated, put differently. Whereas privates don't trade or follow the indexes. They follow the fundamentals of the real estate. So we, at Avenue talk about publics and privates and say, well, we have a lot of great peers in both spaces. There's a lot of multi-billion-dollar platforms out there. The question for the investor is, am I looking for a good short-term trade solution? Maybe a public's a great option because I want in, I want out, I want liquidity, and I want to take advantage of market momentum. Buy a REIT, buy the index, you're pretty much doing the same thing. But if you want to drive correlation to the fundamentals of a certain asset type in a certain geography, for example, 2023, I will dub the year of the multifamily apartment, given the supply and demand imbalance, then go into a private REIT because you get correlation to the fundamentals. And when you're choosing that private REIT, it's about the size of the REIT, what type of assets are they purchasing, where are they geographically located, and then what are your beliefs as the investment house, as the investor, with the outlook on those markets. We'll take the prairies, for example, in our backyard where I'm sitting today in Calgary, and it's cold, so hence my sweater. We have some of the lowest supply per capita available in the country. We have positive in-migration due to interprovincial, international, and we still have some of the most affordable rents in the country. And so when you look at those fundamentals, we have a long road to run in terms of growth in the space that we live in. So an investor looking at Avenue who checks the boxes of governance and valuation methodologies and size and scale and track record, and then looks at the geography, looks at their specialty of operations, you check all those boxes. And at the end of the day, if you want some correlation to a region that's not in your backyard, because maybe you're out east or maybe you're out west, this becomes a very nice vehicle for investors to get great risk-adjusted returns and diversification.
Nice. Yeah, that's very, very well put and a great explanation. We've put out some videos just kind of comparing the private REIT space and the return that we've seen over the past 5 to 10 years versus the public REIT space. And like you're saying, how those public REITs can be very volatile and kind of go with the market. That's definitely been highlighted, especially in these last couple of years.
Absolutely. Absolutely. We've done our own analysis on exactly that. And I think one important piece to mention is that public REITs trade at a price, a stock price, while private REITs trade at NAV. And the interesting thing is if you go into the financials of any public REIT, they're reporting their NAV as well. And how we report NAV and how they report NAV is the exact same because we all follow international financial reporting standards. And under those standards, there's a certain segment of how you do valuation. What ends up happening is when public REITs, trade, at times they'll be at a premium to NAV, at times they're at a discount to NAV, and there's tons of volatility along the journey. But empirically, we've evidenced that when there is an exit or there is some kind of private to go public, traditionally these investments converge to NAV. They converge to NAV or a premium to it. So really, it's are you looking to trade and be short term? Are you looking at long term investment correlated to the fundamentals?
Mm-hmm. Yeah. And we like the boring old privates trading at NAV. It's worked well.
Absolutely.
And then you see some rent caps in Ontario specifically. Do you have any concerns about rent caps in Ontario or about rental caps popping up in other provinces?
Yeah, look, I would say that Alberta, Saskatchewan, there is limited rent control. In terms of how much you can raise rents. You have to be socially responsible. If you've got a customer, you cannot be egregious with your rent increase. Otherwise, you're going to be splashed on the front page of every media outlet out there. So we have to be careful of that. Mm-hmm. But it's really, akin to the idea that these markets and some of our geographies in the US as well have been low to no rent control markets. It allows us to pass through cost increases, rate increases in real time to our customer responsibly. And, we're a very data-driven organization. We do it taking into construct the affordability. Our customer on average at Avenue Living makes $60,000 a year. Our average rents right now are about 24% of those average incomes. And affordability is measured at 30. So when we're out there pushing rent increases, we are making sure that our rent increases don't push them beyond the point of affordability because it's not sustainable. And so it takes a very responsible operator to play in jurisdictions that don't have rent control, to be socially responsible about it, but also drive strong profitability and great reactions. In terms of rent control coming to these jurisdictions, always a possibility. Do we get concerned about it? Not really, because it becomes a different method of managing your asset. What ends up happening is incumbents in your assets tend to play by a different set of rules when they know that going next door is going to cost them more money. And so you end up with less turnover. You end up with stickier tenants. Sure, you can't raise rents as much as you'd like to unless they actually turn over. But it's really akin to a much more stabilized portfolio. And when I look at the fact that we've got a 16-year track record, the amount of units we have, the performance we'd be pretty comfortable in those environments should they ever arise.
Mm-hmm. That's good to hear. And, everyone's keenly aware of interest rates have been kind of going up consistently for the last little while. Can you tell us a bit about how that would affect your business?
Yeah, I mean, we've been living it since the start of 2022. We look at interest rates both from a short-term and a long-term aspect. We have a very active treasury management team here that really is focused on making sure that we have not a lot of value at risk at any given time that are exposed to interest rate increases. So, if we think about the bond yields, for instance, since the beginning of 2022, the bond yields have gone up threefold. And if we think about the prime rate, as we're all aware, it's also gone up by 2.5 times since the beginning of 2022. And so when we look at those rate increases, the Avenue Living book of debt has not moved to that magnitude, the rate that we pay. And we have, again, through the vehicles of debt that we use and the instruments we use, things like CMHC or Freddie and Fannie in the US, we create insulation to the debt or the interest rate exposure. And in real time, because we're anticipatory of a future state at higher interest rates, because eventually all debt matures and has to roll over, we are in real time flowing through the increases in potential debt borrowing costs and even inflationary pressure to the customers through real-time rent increases. I'll give you a great example. For the month of February, our renewals are going out at 15% and our new leases are trading out at 20%. Again, measuring that affordability construct for our customers and doing it reasonably and responsibly, but our ability to have those tailwinds allow us to propel and increase margin in a time where our cost of capital is still remaining flat, insulates us for future period debt increases.
Mm-hmm. Okay. And how do you explain the difference between apartment real estate prices and individuals' home prices? We've seen a lot of volatility in our home prices. It's been coming down lately, and then with the apartment REIT, we see kind of the portfolio of apartments. It's staying pretty steady, kind of consistently increasing in value. How come we see so much volatility in our home prices, but not in the apartment REIT?
Absolutely. Great question. And I always have this kind of tagline that the home you live in is not the real estate you invest in. And really it comes down to the fact that the price of ownership and the use of space for your own person and being the owner operator does not follow the same fundamental dynamics of real estate math as having an investment property in an apartment. And what I mean by that is you're not measuring utility in some kind of rent payment you pay for yourself. You like a home, that's what you like. It's a supply and demand balance. The more supply available, the higher the cost of capital, the harder that home is to price or adjust. And if you've been riding a bull market for over a decade, which we know Ontario has, things are going to be volatile in that market. But you look at the fundamentals of apartments, which again is renting for cash flow, the use of the space. So long as that cash flow is reoccurring, is growing, and is able to be consistently occupied in terms of the units, then the fundamental drivers of that asset allow you to have reoccurring cash flow that then gets valued at some kind of multiple, which right now is staying fairly static across the markets. And you end up in a position where you can continue to accrete value in that space. So totally different valuation methodologies. When you're in a home that you're buying, it's an emotional decision. When you're in a asset that you're buying for rental, it's more of a sustainability and long-term longevity decision.
Okay. Yeah, that makes sense. And how is your the Avenue Living apartment REIT? How is that valued? Who does the valuations? How often do they do them? Just at like a high level.
Yeah, so it's an ongoing process. It's really multiple layers. Management starts with the valuation model that we refresh every single month. In order for us to put data inputs into that model, average rents, vacancy, expense line items, taxes, whatever that may be, we get that in real time based on appraisals and actuals. So when I say appraisals, we go to national appraisal firms. We go to groups that are AACI accredited. So it's the Appraisal Institute accreditation, and that they're recognized brand by our banks, by our auditors. The other part of the tension in the line in the valuation methodology is that we have to demonstrate to our auditors our valuation model, our corroboration through third-party appraisals. 2022, our financial statements are actually coming out today on the 28th of February. And we had to go and do, well, we not had to, but we did 43% of our appraisal, of our volume in appraisals. So we got brand new appraisals, send them to our auditors, they review them, they send them to their transaction real estate group, they approve them, and then we end up crystallizing our valuation. So that's a very disciplined methodology. And then I think the other piece in direct, given that we're the direct owners and our investors are the indirect investors, but in direct ownership, we're working with the lenders as well. And the lenders are the tension in the line, where if we are borrowing against assets, we are showcasing to them the value of those assets, and they're corroborating it with their own underwriting. So there's a lot of checks and balances in our business to ensure that the value we carry is the value that these assets are worth. And plus, we transact a lot.
Yeah. And with a private investment, a private real estate investment, what are some of the risks that you have, or a risk that an investor has, maybe that they'd also experience if they're investing in a public stock market REIT, or things that are unique to the private market?
Yeah, I think one of the risks that you see is liquidity that comes up quite often. And of late we've seen a lot of headliner risk about privates and having to gate, et cetera. Anytime we hear about somebody in the private space that's put the gates up, the first thing we do is we go in and understand the why. Is this market systematic, or is this an unsystematic idiosyncratic risk to that particular firm or firm specific? And a lot of times it's firm specific. It has nothing to do with the assets they own. It's a policy that they have in place. It's a liquidity event. It might be just some mismatch of duration of debt and cash flows. And really that is the one risk that you look at in the private space of REITs. Now, I will contrast that though. When typically you see an elevation of liquidity requirement, it's because the market is panicking. There's nerves, there's concern, there's angst. And if you're seeing the angst in the private space with elevated redemptions, and for the record, Avenue has had fairly stable redemptions since its inceptions, never missed one, very comfortable. Like we actively manage treasury. But when you see an elevated level of redemptions, at the same time, you're seeing a sell-off in the market because people are just trying to go to cash. So when you look at those exact same periods binary, by having liquid public REITs, you may have liquidity available, but you might be now selling at a substantial discount to when you bought it. I'd take some of our publicly traded peers back when 2020 of March, April happened, and the pandemic was just setting in, and the uncertainty in the market was phenomenal. I'm sure those were pretty stressful days for yourself at that point. Mm-hmm. And people were looking at the stock prices of our peers, the giants in Canada, the titans of industry, and their price was 50% of what it was the day before or 2 days before. Well, great. How's that liquidity working out for you? Go ahead and trade, but now you're in a pretty tough position. So when choosing a private, understanding that liquidity is a risk, but making sure that the manager has a very active management approach to that liquidity becomes the counterbalance to that. And then recognizing that you're in a long-term investment, that the manager will be the market maker, they will make you whole as long as the foundational principles are there, and that they have a diversified base of equity, they've got scale, they've got size. I think that would be important. Other than that, they're very comparable in terms of public and private. Both have professional management. Both use the same methodologies of valuation. Both tend to have, their core competencies of their strategies in play. But then it's really trying to find what makes sense for you.
Mm-hmm. Yeah, and when we have our back office looking at a private investment like yours, they're often citing the liquidity as a reason that might have to be rated high risk. Whereas a similar REIT that trades in the public market, just like you're saying, might be rated medium risk, but has the potential to drop, 30 to 50% in a couple months. And we've seen that not once, but twice, since the beginning of the pandemic, those types of drops and rebounds. So I guess just in like a worst case scenario, let's say, you had to gate the fund, there were more redemptions than money coming in. You had to put a pause on redemptions for a period of time. What happens to investors? How do you work your way out of that? And how do you protect the return of the overall fund through a period like that?
Yeah. So in that case, ultimately, if you ended up having to gate, in principle, if there's nothing fundamentally wrong with the business and the rationale for gating was a rational exuberance through market dynamic, the business should continue to carry the day. So you have reoccurring cash flows, you've got access to leverage, you've got the ability to generate value gains. That preservation of the capital space to not issue the redemptions and keep liquidity in the system will enable you to continue to operate your business accretively. And so those investors would continue to get paid their distributions, they would continue to have NAV accretion. And then in the interim, what management would do in practice is work on a liquidity plan. Whether that liquidity plan would be, let's get some more leverage. I mean, we keep a pretty low level of leverage. I think we ended 2022 at 56% leverage. Industry standard for real estate lending is 75. So you can go up to there. It's not a comfortable place we would want to be, but you could go up there. So you could generate liquidity. Second thing that you could do is you could go out and utilize the cash that you have in your treasury, should you need to. I mean, we keep a substantial amount of cash in treasury. Actually, we keep about 10% of our redeemable equity in treasury at any given time to make sure that we have that. Third thing you could do is, if you are, as ourselves, the second largest building owner in Canada, and so we've got over 450 individual structures, there's no reason why you couldn't start to sell parts of your portfolio to generate the liquidity. But at the end of the day, what you are doing is you are preserving the wealth of the investors that are in, along with the investors that have been gated. You have a plan of attack to ensure that you're preserving that wealth, generating the liquidity, and then you create an arrangement to start providing those redemptions when you need to.
Mm-hmm. Yeah. And we do like that option, that ability is built in there to gate an investment. And, we see it as a way to protect us as long-term investors, because we're not, pulling out in a market correction because there's fear or optimism in the market. We want to hold on the long term, and some of those things that you're explaining actually protect us and our clients throughout periods where there might be high redemptions for some unforeseen reason.
Yeah, and I think for us, a bit of a uniqueness is, we've got significant volume of equity holders. I mean, we've got over 7,500 of them, for example, in the core trust, so that there's no one single investor that could create that issue. You're looking at something more systematic, and being through the pandemic and the experience that we had last year, things were pretty even keeled from that perspective. And I think the other piece of it is that the founders and their family still have 25% of the capital stack in the organization, which is permanent capital. And so when you have that level of commitment by the founders, you know that the net redeemable investments tend to be more longer term in nature with the founders and the partners. So it gives you a level of comfort in our business that has proven out over the years.
Yeah. And are there any other like headwinds or tailwinds that you see upcoming in 2023 that we haven't talked about so far?
Yeah, I mean, great question. I mean, I think headwinds on a national level have been inflation, have been the treatment to curtail inflation with interest rates, and I think that we have very, very dynamically managed through that piece of our business and continue to do so. I think the emerging tailwind that continues, and why I said multifamily 2023 is the year of multifamily, is this massive supply and demand imbalance. So when we think about multifamily apartments, they have not been constructed to the volume that Canada needs. Actually, if we look at it empirically over the last 20 years, the reduction in supply per capita has gone down by about 20% for purpose-built apartments, because people were focused on building condos and home ownership, et cetera. And in that same time period, actually not even that time period, in the last 3 years, home ownership rates have gone down by 3%. We were at 71% home ownership rate in Canada. We're now at about 68. So you have more people who want to rent. You don't have enough rental supply, and you pile on the fact that we have a policy of 500,000 new Canadians coming in over the next 3 years per year, which, you take that into account, the US average historical is between 500,000 to 1 million new immigrants a year. And Canada, which is 1/10 the population, is going to do 500,000. So a bit of a powder keg for our business, which will emerge as substantial tailwinds in the short, in the near term, in the medium term, to continue to propel our business. We as an organization need to do it responsibly, be active participants in this market, and drive really good customer service to our customers to create the retention that we want. Mm-hmm. But we see this as a massive opportunity. And I think that the market will build and catch up with supply. But if anybody on this call has ever done a home renovation or done a project, you know that that's not happening overnight. That's going to be a multi-year journey, and that eventually we will catch up. But in the interim, there's going to be some great opportunity for us.
Nice. Yeah, those are definitely some strong tailwinds. And you mentioned the interest rate there. Do you know off the top of your head, like the average borrowing rate that you have for the apartment REIT?
Yeah, I mean, I'd say we're in the high threes, low fours. I'd say that the prevailing rate right now is probably in the low fours for 10-year money under CMHC. And I would tell you that portfolio is pretty much in that realm.
Great. And just last question, do you have any forecasts for returns or that we might be able to see in 2023?
Honestly, with I'm going to say this lightly, the hard part behind us, we just got through a pandemic. We just got through one of the most volatile years in financial history. and now we have these emerging continued tailwinds of our business, I would be hard pressed to not see more of the same of 2023, if not better. I think that fundamentally we should do better, and we're hoping to see that flow through in our returns.
Yeah, that would be absolutely incredible.
Actually, I think we just had a NAV bump today as well, so there's an opportunity right there. That was great right early in the year.
Oh, perfect. That's always great to hear, and it's nice to start the year off strong the way you started last year and the years previous as well as this year. So thanks very much for sharing some of your time and your expertise with myself and our clients and the other viewers. And hopefully we'll get the opportunity to speak with you again in the future.
Thank you, Cody. I really appreciate the forum.